back to the channel. Today we re-diving into Eternal Limited SQ2 FY26 results, formerly known as Zomato. This quarter was packed with growth stories, challenges, and some big strategic shifts. Let us break it down in simple terms so you can understand what is really happening behind the numbers. First up, food delivery. Eternal S food delivery business grew its net order value. That is basically the total value of customer orders by 14% compared to last year. Growth had slowed down in previous quarters, but now it looks like things are starting to recover. Profitability also improved, with adjusted EBITDA margins hitting a record 5.3%. That means the company is squeezing more profit out of each order, even while keeping prices attractive for budget-conscious customers. Now let us talk about quick commerce, or Blinkit. This is the 10-minute delivery business, and it is on fire. Net order value shot up 137% year-on-year, the highest growth in 10 quarters. Eternal added 272 new stores, bringing the total to over 1,800. Margins are still negative, but improving. Why? Because the company shifted to owning inventory instead of just being a marketplace. That means they now buy and sell goods directly, which boosts revenue, but also increases working capital needs. It is a bold move, and Eternal expects this model to expand margins by about 1 percentage point over the next few quarters. Eternal isn't just about delivery. They're going out. Segment, dining, movies, events grew 32% year-on-year. Losses widened a bit, but that is because they're reinvesting heavily in building new categories like district stores, which digitize offline retail. They even expanded district into the UAE, combining dining and live events into one app. It is early days, but the company sees this as a long-term play. Hyperpure, the restaurant supply business, grew steadily at 42% year-on-year, but Eternal deliberately scaled down its non-restaurant business, leading to a sharp revenue decline overall. The restaurant side is close to breaking even, and management expects it to turn profitable within the next 2 quarters. Put it all together, and Eternal S consumer-facing businesses grew net order value by 57% year-on-year. Adjusted revenue jumped 172%. But remember, that S inflated by the new inventory model. On a like-for-like basis, growth was 65%. Profitability dipped compared to last year, with adjusted EBITDA down 32%, but improved quarter-on-quarter. So the company is balancing growth investments with profitability, and management says they are comfortable sacrificing short-term margins for long-term sustainable growth. So what is the takeaway? Eternal is betting big on quick commerce, expanding aggressively, and reshaping its business model. Food delivery is stabilizing. Hyperpure is nearing profitability, and the going out segment is being built for the future. Yes, margins are under pressure, but the company is confident in its long-term strategy. Investors should watch how quickly Blinkit's margins improve and whether food delivery growth continues to recover. That is Eternal SQ2 FY26 story in a nutshell. If you found this breakdown useful, hit like, subscribe, and let me know in the comments what you think about Eternal S bold moves. Thanks for watching.